What's up, guys? If you're new here, my name is John, and yes, I am back making more informative content for all of you. Well, I have always been here, just took a while to release another video. Today we are talking about a newer REIT that has only been around since July 1st of 2021. This REIT has been paying a consistent dividend, but has had a dropping share price since it went public. Is now the time to buy this REIT. The REIT I'm talking about is Orion Office REIT, ticker symbol ONL. That's right, the office REIT that Realty Income created when it merged with VEREIT. After that merge, they used their spin-off company, Orion Office, to, you guessed it, get rid of their office portfolio by placing it there. Now, we don't know if they did it to better classify their properties or if they knew that after the pandemic there wasn't going to be a rush back to the office, which would have affected their bottom line. If you owned Realty Income in 2021 before they created Orion, you probably owned Orion shares since they were provided to all Realty Income shareholders. Well, either way, we know this stock has been affected and that the share price has dropped hard since its inception, but has been able to maintain a consistent dividend so far. Is it time to take a risk on this company? Let's take a look at Orion's website and get more information on this REIT. Orion Office REIT specializes in the ownership, acquisition, and management of a diversified portfolio of mission-critical and corporate headquarters office buildings in high-quality suburban markets across the U.S. The portfolio is leased primarily on a single-tenant net lease basis to credit-worthy tenants. The company's team of experienced industry leaders employs a proven, cycle-tested investment evaluation framework which serves as the lens through which capital allocation decisions are made for the current portfolio and future acquisitions. They continue by saying Orion has prioritized maintaining a balance sheet positioned to support a growth-oriented business plan. With conservative leverage and strong liquidity, the company can opportunistically take advantage of high-quality acquisition opportunities. In addition to earning growth, Orion seeks to augment returns for shareholders with a sustainable dividend. Environmental, social, and governance initiatives are critical to our success. The company is focused on actions in coordination with tenants that are designed to have a long-term positive impact on all stakeholders. Let's look at their current portfolio. It looks like the Orion portfolio consists of 81 wholly owned properties and 6 unconsolidated joint venture properties, diversified by tenant, geography, and industry. None of Orion's tenants represent more than 12% of the portfolio by ABR. By the way, ABR stands for annualized base rent, which is the monthly base rent as of the specified date under leases which have been signed or commenced as of the specified date multiplied by 12. So pretty much it's literally the base monthly lease payment or rent that they're charging multiplied by 12. Their website also mentions that the diversity of Orion's portfolio and the high credit quality nature of the tenancy are expected to provide the company with a strong, stable source of recurring cash flow from which to grow their business. The portfolio is cycle tested and its rent collection rate during the pandemic demonstrated the creditworthiness of the tenant base and our ability to continue these key office locations. The portfolio has 73% investment-grade tenancy by ABR as of March 31st, 2023. I will say that even with some companies bringing employees back to the office and other companies keeping their employees remote permanently, Orion has been able to consistently charge rents and continue diversifying its portfolio to shield it towards the future in case there is a big drop in the commercial sector. The thing is, they officially spun off Realty Income in November 2021, so they have only known the 2022 market when some employees did return to the office. So for them to say they did well during the pandemic is kind of misleading because they weren't a company when offices were closed. One of the reasons I feel like Realty Income and VEREIT created Orion was because maybe they did not know the future impact of that portfolio once employees were asked to return to the office or stay remote. I mean, in their Q4 2022 press release, they reported an occupancy rate of 89%, with 73% of annualized base rent derived from investment-grade tenants, and the portfolio weighted average remaining lease term was 4.1 years. And in their most recent Q1 2023, they reported an 87% occupancy rate, which means that it's actually gone down. Now, most REITs I invest have an occupancy rate of 95 to 99%, so 89 would make me nervous. But I also understand that office REITs have been affected more than commercial properties. There's some great news for their occupancy rate though. Looks like during the fourth quarter of 2022, they were able to sign new lease renewals with current tenants, with 2 tenants entering into a 10-year lease renewal for a total of 213,000 square feet at 2 of the company's properties in New York, and 1 5-year lease renewal for 90,000 square feet at one of the company's properties in Lawrence, Kansas, and another renewal for 5.4 years at a 4,000 square feet property in the Woodlands, Texas. I don't think Orion is having any issues renewing their properties. The issue is leasing to new tenants. Seems like some tenants are just waiting for their lease to end since their employees are now remote. And some tenants already have another management company they work with and are not looking to switch. Let's take a look at their financials. So Orion Office REIT is currently trading at $6.76 a share. When the company started trading in the stock market on November 12, 2021, it opened at $32.25 a share and closed that same day at $23 a share. That's a big drop. I remember selling the company around $19 a share, which didn't take long to get to that price. We know now at that time that the company was trading at a very expensive markup and has since dropped to what most would consider a discount. But is it? The 52-week low is $5.27 a share, and the high is $11.25, and since has fluctuated this past month between $6.19 and $6.96 a share. For a low share price, we do see a high volume of shares traded a day, with an average volume of 483,362 shares traded. In their most recent earnings release for Q1 2023, they reported a total revenue of $50.2 million. It reported a net loss attributable to common stockholders of $8.9 million or 16 cents per share. The FFO, or funds from operations, came in at $23.5 million or 41 cents per share. If we compare that to Realty Income, which I know it's technically apples and oranges in this case, but they are both REITs and they both rely on their FFOs as a measure of health for the company and its dividend payout. In Q1 2023, Realty Income reported an FFO of $1.04 per share. If we narrow it down, we can see that Realty Income's AFFO, or adjusted funds from operations, which is available to common stockholders, was 98 cents per share, and they pay out a 25 cents per share dividend. Currently, Orion pays out a quarterly dividend of 10 cents per share, which puts its current dividend yield at 5.94% or 40% annually. As you can see, it has been paying that same dividend since its inception on March 30th, 2022, and has not increased it since, but it has not cut it either. The company currently has agreements in place to sell 8 additional properties, representing 631,000 square feet for an aggregate sale price of $41 million, including 6-property Walgreens campus in Deerfield, Illinois. Looks like they have been selling buildings the past 2 quarters. They could be preparing to hold cash by selling properties that won't be renewed as to not add to their non-lease percentage, or they could also be trying to ride out the next few years as new commercial properties come into play without enough tenants to rent them, and they could come in after and swoop in and purchase them at a discount. Or they need the cash to keep the company afloat by paying its debts and trying to become profitable. As of March 31st, 2023, the company has a total debt of $557 million, comprised of $175 million under the credit facility term loan, $355 million under the company's securitized mortgage loan, and $27.3 million, which represents Orion's pro rata share of indebtedness of the unconsolidated joint venture. As of March 31st, 2023, the company had no outstanding draws under its $425 million capacity credit facility revolver. Seeing a REIT with debt is not surprising. Most of them have a revolving debt and line of credit, since that is how they make a lot of their acquisitions, by going into debt or selling shares of the company to raise capital. The company's outlook for 2023 is a core FFO range of $1.55 to $1.63 per share. Its 2023 general and administrative expense guidance range of $18.75 million to $19.75 million, and its 2023 year-end net debt to adjusted EBITDA guidance range of 4.3 times to 5.3 times are unchanged from last quarter, but I think their balance sheet is going to look inflated based on their recent property sales. Here's the thing. I think a lot of the pain for commercial properties has already been priced into the stock, and recently it has managed to stabilize its share price. But as much as I think most stocks are seeing a nice bull run and believe there is a lot of price appreciation to be had in this market, I think that Orion Office REIT still has some more pain to go through. Home sales might still be strong, even with a high interest rates, because there isn't as many sellers, but commercial properties can't say the same. The process to acquire a tenant for a commercial property can take a long time, and although when leased you don't have to worry about leasing that property again for another 5 to 15 years, it does come at a cost when there isn't enough tenants. Most analyst websites have labeled ONL a hold. And I think this is one of those companies that if you want to buy it at this price and don't really care what the share price does because you're chasing the dividend, then just make sure that that dividend can be sustained by the company, or you might end up with an AGNC stock situation where neither the price of the stock or the dividend increase and are constantly cut instead. There's a lot of good REITs out there that are currently undervalued because everyone's jumping on the growth stocks while the market gets excited and the fund managers get FOMO. It's time to start looking at those undervalued stocks or REITs that have shown not only increasing revenues but stable dividends and price stability, if not price appreciation. If you wanted to get into some of these stocks that have those growth, you should have been in those stocks already. But it's never too late when we're talking about long-term investing. This is something that you can look at 10 years from now, 20 or even 30 years from now. Then you don't have to worry too much about the price and the share price right now, as long as you see that the company has value and the company has a future, as well as a plan to get to that point. See, I like good combination of dividend-paying companies, growth companies, and a risky investment or two. So that's just my point of view. If you found the video informative, give the video a like and consider subscribing. See you in the next one.